October was a month characterized by high volatility in short-term interest rates worldwide. The background for these movements was the fact that the elevated levels of inflation that we have observed in many countries in the months after the COVID crisis may be of a more persistent nature than previously anticipated. This has turned to the traders and the market participants expecting central banks to move forward their hikes of the signal rates, leading to greater uncertainty as to the interest rate development going forward. Despite the turmoil in the fixed income markets, we have seen the stock markets continuing to move higher and setting new all-time highs by the day. On the bond side, we have seen credit spreads staying mostly stable, or in some cases actually widening somewhat in particular sectors. We can mention the real estate sector, where a large amount of new issuance from Swedish real estate companies, possibly related to the ongoing consolidation in the real estate market, which has put pressure on spreads in this sector of the credit market. So far in 2021, we have seen a great amount of new issues coming from the Nordic companies in the bond market. In particular, we've seen a great amount of issuance from, in particular, Swedish real estate companies, and but also from other parts of the industrial sectors in the Nordic countries. At the same time, we have seen an increase, an ever-increasing demand and appetite for green bonds. And for the Norwegian market, in Norwegian kronas, we have actually had about 50% of the new issuance from corporate bonds has actually been in green format. For DB fund Nordic investment grade, the return in October was slightly negative. There are two reasons for the negative return in October. First of all, the increase in interest rates has contributed negatively to the fund's return. The fund has a relatively short interest rate duration. However, rising rates still affects the fund's performance somewhat. In addition, the increase in credit spreads for certain segments of the corporate bond market, in particular the real estate market, has also put some widening pressure on the credit spreads, which has also contributed negatively to the fund's performance. Since inception in April 2021, the fund has delivered a return of around zero so far. On the positive side of the equation, we find contribution from lower rated credits, such as subordinated financial bonds and BBB rated corporates. On the negative side, the main contributor has been the increase in short-term interest rates. When it comes to the fund's exposure to different sectors, the two largest sectors are the bank's financial sector and real estate sector. This is a consequence of the composition of the market in general, but also an active choice from our side, as we find value in the bonds in these two sectors. When it comes to currencies, at the moment we have the largest part of the fund in Norwegian kroner, around 50%. This is an active choice from our side as well, as we find the bonds in the NOK market providing a better value than the other markets currently. When it comes to country exposure, currently the two largest countries in our portfolios are Norway and Sweden, which also are the largest components of the market in total. Going forward, the markets will probably still be characterized by the uncertainty about when and how the central banks will start using the interest rate weapon to fight off inflation. In Norway, we do already see that the market has priced in several rate hikes from the central bank, and as such we have skewed our interest rate duration to primarily be in the Norwegian kroner market. When it comes to credit spreads, these spreads are currently at historically tight levels, and consequently the main bulk of return will probably come from the carry element from the credit spread and not from the compression of credit spreads. However, there are still pockets of investment opportunities which provide attractive risk-return characteristics which we intend to make use of.